One of the most striking features in 2016 was the resilience of the global economy amid high political uncertainties from the Brexit vote, the US elections and the constitutional referendum in Italy. Encouragingly for 2017, key sentiment indicators have picked up lately. The global composite PMI, for example, has recovered to its highest reading in more than a year in December. We anticipate global growth to pick up from 3% last year to 3.3% in 2017. This slight pickup should not distract from the fact, however, that global growth will remain well above the post-war norm for longer. Furthermore, two-thirds of the 2017 growth acceleration will be merely due to ending recessions in Russia and Brazil, with the US accounting for the remainder. Despite robust domestic demand, fading tailwinds from low oil prices will keep expansion in the euro area slightly below the 2016 average. Deflation fears will continue to ease. Over the second half of 2016, long-term inflation expectations have already recovered from depressed levels. Headline inflation rates will temporarily even spike near-term, owing to recovered energy prices. That said, hopes of a period of swift global deflation look premature. Growth acceleration and a faster normalization of inflation will be a theme for the US. But in Japan and the euro area, the path towards higher underlying inflation rates, that means once volatile effects from energy and foods are stripped out, will still prove a very sluggish one. The strong support for monetary policy seen over the past year will subside in 2017, even though unevenly. After hiking in December, the Fed is likely to raise rates by another 75 basis points this year. The US economy seems set to weather higher rates well, but the resulting rise in US yields and the stronger dollar will burden countries in the emerging world that have incurred large US dollar debt. The ECB will lower its asset purchases from 80 billion to 16 billion euro per month from April onwards, but continue to prove an important backstop for pressured countries in Southern Europe for most of this year. Towards autumn, however, continued resilient growth and mildly recovering inflation rates may start a debate of when the ECB will start to taper its asset purchases. Resilient growth and easing central bank support will trigger a slight increase in global yields from still low levels. This holds in particular for the US, where we foresee higher rates and mounting price pressures. The transmission to European yields will be very muted, though, given the still accommodative ECB and a sizable output gap in the euro area. US equities look expensive, while European stocks may render low positive returns. Higher yielding corporate bonds in the euro area look attractive thanks to the ECB, a favorable rating drift and a resilient growth outlook. The risks to this outlook arise mainly from politics. The new Trump administration in the US will likely underpin growth via tax cuts and infrastructure spending. But with policy details still missing, there is an elevated risk that Mr. Trump's measures will harm global trade and add to geopolitical uncertainties. In Europe, elections in the Netherlands, France and Germany will confirm the rise of populist parties, while centrist forces should ultimately prevail in forming new governments. A surprise victory of Mrs. Le Pen in the French presidential elections, however, could question European unity. Further risks arise from potential early elections in Italy, where a fading reform momentum and a troubled banking sector already weigh on investor sentiment. These events may temporarily weigh on risky assets and yields alike. However, following last year's experience, we should not underestimate financial markets' capability to ultimately cope also with adverse political events in 2017. Thank you very much for your attention. We will keep you posted.